Imagine this: you're watching a massive bubble slowly inflate, filled with your hopes, dreams, and investments. Now picture that bubble popping. How prepared are you for the aftermath? Hey there, EARNOLOGY community. Today we're going to burst some bubbles, metaphorically speaking, as we uncover the shocking reality of the current stock market. Trust me, you don't want to miss this. Throughout history, we've witnessed some major market bubbles. The Great Crash of 1929, the Nifty 50 decline in 1972, and the dot-com bust of 2000. Each of these events taught us valuable lessons about market behavior and the dangers of speculation. Fast forward to today, and many experts believe we're on the brink of another significant downturn. Some are calling it a super bubble, marked by extreme overpricing, speculative behavior, and an unusually long bull market. But what does this mean for you and your investments? Let's break it down. A super bubble exhibits specific characteristics: a long bull market, rapid acceleration in stock prices, and speculative stocks beginning to decline even as the broader market continues to rise. For instance, from the onset of COVID, the Nasdaq more than doubled, and the S&P 500 soared to new highs. Yet, nearly 40% of Nasdaq stocks are down over 50% from their peaks. This pattern is eerily similar to the tech bubble of 2000. So what can we learn from this? Historically, when speculative stocks fall while the market rises, it's often a precursor to a broader market decline. In 1929, 1972, and 2000, this was the case. Today we're seeing similar signals. But it's not just about the numbers. There's a psychological element at play: the fear of missing out, or FOMO. This terrible lust to participate in profit-making is incredibly seductive, especially at the end of a great bubble. Trust me, I've been there. A few decades ago, I made a fortune but wiped myself out. It was a tough lesson, but an invaluable one. I want you to avoid the same mistakes. Get rid of the fear of missing out. Focus on high-quality, financially sound stocks, and consider diversifying outside the US. Countries like Australia, the UK, and Japan have reasonably priced markets. Emerging markets, despite their risks, are incredibly cheap and could offer better long-term growth. While the US market faces extreme overpricing and speculative behavior, many international markets are merely overpriced, not dangerously so. This includes some emerging markets that are priced attractively. Remember, cheapness often trumps other factors in the long run. Let's also talk about inflation. Historically, the stock market hates inflation because it crushes price-earnings ratios. This time, uniquely, the market has ignored rising inflation. However, if inflation becomes embedded, it will mercilessly depress price-earnings ratios. The Fed is likely to raise rates to combat inflation, making it a tough environment for stocks. So what should you do? Focus on value. Emphasize cheap stocks and countries. Carry some cash reserves for potential buying opportunities. Stay away from expensive markets and speculative stocks. And most importantly, stay calm and avoid the seductive pull of FOMO. Remember, markets move in cycles, and no bubble lasts forever. By staying informed and making smart investment choices, you can navigate these turbulent times successfully. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more insights on navigating the financial markets. Until next time, stay savvy, EARNOLOGY community.